Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Today, I'd like to talk to you about the implications of selling property, real estate specifically. And we're not just talking about simple transactions here, we're talking about the possibility of you having left India's shores and either you being a non-resident Indian or you having given up your Indian passport. What are the tax implications then? And how do you manage everything so that you don't get a call later or a message later from the IT department, and to also ensure that the buyer that is buying the flat from you or the house from you is also compliant with regard to India's tax laws? So to talk about all of this, I'm joined in studio by CA Abhishek Mehta, who is the founder of Investor Capital. Thanks so much for taking the time, Abhishek.
Thank you, Alex.
So let's start with this. First, let's start with the most basic transaction, which is the sale of a house. First of all, it's not the easiest thing to do. And so in order to be compliant, what do you need to know?
So the first thing you need to know, if you are selling a house which is more than 50 lakhs, the buyer has to deduct 1% as TDS.
Okay.
That's accumulated. It's not that if 4 people are selling for a 2 crore and they 49 like they divide it, still you will have to deduct 1% TDS.
If the value of the house is more than 50 lakhs.
Second thing, you have to pay on the profits almost about 12.5% without indexation as tax. And if you take indexation benefit, which is basically you increase the purchase price of your property by the inflation rate, there is a CII index chart which comes by the income tax department. You will have to pay 20% tax on that. One very important thing is, if you have bought a property which is before 2000, so you'll have to do a registered valuer's, you have to take a valuation report from a registered value dated 1st April 2000 and then take the indexation ahead from
because
there.
The index starts in 2000.
2000, yes, 1st April 2000. So anybody who has purchased property before that, they can take the benefit of, getting a registered valuer's valuation report and then doing the indexation.
There must be some math about what is favorable at what point, and I know that you would necessarily have to do it when you calculate your profit yourself.
Yes.
But then broadly, and I remember seeing this when the announcement did come through, that if you have had a compounded annual growth rate of above a certain percent, then this is beneficial. If it's below this, then that is beneficial.
See, more or less, I have seen people end up paying almost 12.5% only on the profit.
Okay.
So even after doing the indexation benefiting and you put the tax of 20% on an average on the entire profit. So if I bought something for 100 rupees, I'm selling on 200. The difference, 100 rupees, I will be paying 12.5% tax on that, whether you take indexation benefit or you don't take indexation benefit. In a lot of cases, I'm nowadays seeing after taking indexation benefit, there is a loss coming because property market have not done well in the last 5-7 years. So a lot of people are getting short-term or probably long-term losses also on their property after taking indexation benefit.
Interesting. So there's no tax outgo. In fact, you can actually set that off against future capital gains. Is it the same rule that applies where you can keep it for 8 years?
Yes, you can keep that money for 8 years or probably set it off against your long-term capital gains of equity shares or mutual funds. You can set it off against those things as well.
Sure. So we've talked about calculating either 12.5% or indexation.
Yes.
What else do you need to know?
One thing is, if you're buying a property from an NRI, you need to deduct almost 14.5% as TDS on the sale value, because 12.5% plus 10% surcharge plus 4% cess. So be aware that when you're buying a property from an NRI, so you're transferring your money on an NRE or NRO account, you have to deduct almost 14 to 15% or as a TDS from the
14%?
sellers. Yes, 12.5% plus 10% surcharge plus 4% cess. And you have to deduct the entire amount and pay it as TDS.
So this is important, right? Because if you are found to have not withheld this amount, then you are liable, aren't you?
Yes, the buyer is liable and the penalty will be charged on the buyer depending on the officer's assessment.
And how does that penalty work?
So they have different methods, but more or less, if the NRI doesn't pay the tax, what happens is if you transfer the entire money, he ran off and he's not paying the tax, income tax department will come and try to get that tax from your amount, or probably they will tell you to deposit the entire amount and plus the interest and the penalty and then recover it back from the seller. So you have to be very aware that you have to deduct the TDS. The negative point about this, so see, if I am selling a property which is 5 crore as a NRI, 12.5-14% is really a huge amount.
Sure.
So what NRIs can do this to escape this is, you can go and apply for a lower TDS certificate from your assessing officer. It takes about 30 days to get that certificate, but the assessing officer, what he does is he computes your capital gain and then gives you a certificate stating the buyer has to deduct only 1 or 2% of the sale value.
Okay, so right now you've spoken about it from the perspective of the buyer.
Yes.
But let me ask you from the perspective of an NRI.
Yes.
If you have property in India and you do this certificate, right?
Yes.
So ultimately your outgo may not necessarily be 14%.
Right.
Right?
It will come down to 1 to 2% probably after getting the lower TDS certificate.
No, but then you would have to pay capital gains based on.
Yes.
It could amount to be 12%, etc., right?
Yes, but
12.5%.
Yeah, but this 14% is on the
On the
entire
total
sale value,
value.
and your profit
Sure.
पे आपको 12.5% टैक्स लगेगा. तो that amount is, the difference is huge.
Okay, so more than anything else, it is to ensure that the money does not flee the country.
Yes.
So to keep possession of that money and then to have compliance.
Yes.
So then answer me this from a perspective of an NRI, right? Assuming that you have not gotten this letter, how long does it take for you to settle that tax? It's the whole cycle of an assessment.
Yes, the whole cycle. You will file your return on 31st July, then you will wait for the refund to come back, which might take almost on average 1 to 1.5 years to get your refund back. That's why we urge everybody that you apply for the lower TDS as soon as possible. The second check which also government has is, when you are sending your money back to the country where you are, you require a 15 CACB. So there is a second check also. So even if...
So explain, this sounds like Greek and Latin to me.
Yes.
So you tell me, what is 15
CACB.
Okay.
So once the NRI has got the money into his bank account, it's not that easy that he can just transfer the money to his home country like US or
How
UK.
does that happen?
So you have to go to a chartered accountant, take a certificate from the chartered accountant that you have paid all your due taxes on this money and you are allowed to take this money back.
Okay.
And the CA gives you a certificate, then only the banks let you send that money back to your home country.
Okay, so you've spoken now about NRIs selling and also buying from an NRI.
Yes.
Is there anything else in this transaction that needs to be paid attention to, either from the perspective of the seller or the buyer?
Not much. I think the 1%, see, let's break it down 3 parts. One is, if you're buying normal person who's non-NRI, 1% TDS.
Yeah.
Okay, and 12.5% capital gain tax.
But 1% TDS of the total value.
Of the total value, more than 50 lakhs if the value is there. Second is, if you're buying from a NRI, you have to deduct 12.5% plus 10% surcharge plus 4% cess, or the NRI person can go and get a lower TDS certificate. And third is, you have to obviously pay the capital gain tax, and after paying the tax, you can take the money back to your home country by a 15 CACB form.
Okay, so this is the case of either a resident Indian
Yes.
taxpayer or a non-resident Indian.
Yes.
But here's a third hypothetical scenario. If you are an Indian who bought a property, or who was gifted a property, or who inherited a property,
Yes.
and you have left the country and you have given up your citizenship.
Right.
You've given up your passport, but you have your
OCI card or something, yes.
Yes. In that situation, as a non-Indian in this situation, or somebody with an OCI card, what is the treatment? Is it the same as NRI?
It's the same. You will be considered as NRI only. For
Okay.
income tax perspective, there are only 2 things. Either you're a resident or you're non-resident.
Okay.
So in this case, you will be considered as a non-resident, and the higher TDS deduction will be applicable to you.
Okay. Are there complications in the sale that you have witnessed? And here I'm not talking about only from a tax perspective. And I do not know if you have assisted in the sale of a property by non-resident Indian and facilitated the tax, etc. Have you seen people struggling a little to carry these trades out?
Yes. So if you don't get the lower TDS certificate, you will get the struggle in getting the refund, because the refund amount will be huge. So if you sell a property worth like 5 crores and you deduct 75 lakhs as a TDS, it's a huge amount for the income tax department. So there is a lot of scrutiny. They will ask you for a lot of letters. And what usually happens that NRIs don't have these papers, because they would have purchased the property in 2008 or probably 2004, or probably they would have inherited the property. So they don't have all the papers like possession letter, the payment schedule, the NEFT, UTR numbers, or if they would have sent money from their home country, they don't have the TRC or the FIRC,
What's the TRC or
tax residency certificate from the home country, or FIRC, which is the foreign inward remittance certificate, which the banks give you at the time of sending money.
To purchase the house.
To purchase the house. So a lot of these documents are misplaced during the journey, and that is when the refund gets more delayed.
So is it conditional getting that lower TDS certificate? What are the conditions that could determine the giving of that certificate or the non-issue of that certificate?
So you need about these 10, 12 documents which I said, the payment schedule, the TRC, FIRC, then what was the source of income from where you bought. So all these documents you have to submit beforehand only to the income tax officer. He assesses everything and then gives you the certificate.
And you have to go in person and do this?
Yes. The only challenge which I've always seen is this. It takes about 30 to 40 days to get this lower TDS certificate. And most of the time, the deal fails off within this 30-40 days because the buyer is not ready to wait for that time.
How long is that valid for, the lower TDS certificate?
So the issue is, the lower TDS will be in the name of the buyer only. So you cannot use that lower TDS certificate for some other party. So if I am selling, so if probably I am buying, my name will be there, that the assessing officer will write to Abhishek Mehta, please reduce the TDS and debit only 2% of the amount. But by the time the certificate comes, 30 days, 40 days, 60 days, a lot of time the deal falls off.
And so then the entire process needs to be repeated again. Okay, so is it possible to have multiple names that you do at once, or?
No, only one. Because they ask you for a draft agreement, they ask you for the valuation certificates, a lot of things are asked. So you cannot have two buyers at the same time.
So it is challenging, to say the very least, but at least hopefully now that they know the process, they can actually follow it. Like I was asking, you need to go in person. Do you need to go to the tax department in your domicile?
No, so you have to apply. Usually there is a international taxation department, which every NRI has. So you have to apply online, and mostly all the things are done online only. Very few rare papers are there which has to be submitted, offline.
Okay.
But almost 99.99% of the process is completely online today.
Okay. Now, we've covered quite a bit of the tax aspect. I do want to ask you about what to do in certain scenarios when you are an Indian selling your property, right? Because you have certain benefits available to you in terms of reinvestment of the property, primarily utilization of those capital gains to not pay capital gains tax.
Right.
By my understanding, there are a couple of scenarios that can play out. One, you're buying property or rather you're selling property to invest in another property.
Yes.
Is that only available on your first purchase, or is it available on any purchase that you do?
So in case of a residential house, there are primarily two sections of exemptions which are available. One is section 54 and one is section 54 EC. For section 54, if you have sold your house, whatever the capital gain is there, you can reinvest it into another house. There are certain timelines for that.
Right.
One is, you could have purchased the house 1 year prior to selling, or you can purchase the house 2 years after your selling. And if you are putting, a lot of time people put in an under construction property, so you have 3 years to input your money. Probably the building might take 5-7 years to get developed, but you have to input your capital gain amount within the next 3 years. One important thing which people forget in this entire claiming section 54 is, before you file your return, you have to deposit the amount into a capital gains savings account. So either you have to make the payment to the developer or the seller, and if you have not done it till the 31st of July, please deposit that into the capital gains savings account.
And you have to go and inform your bank that you want to deposit this in your capital gains
so a separate bank account.
And you can't utilize this for anything else.
You can make an FD, but you cannot utilize it for anything else. Whenever you want to make a payment from this account, you have to inform your bank, provide the documents of the payment to the developer or the seller, and then only the bank remits that money.
Understood. Okay, so you've given us a few points to talk about, but does the precondition exist? I can only utilize it for one additional property, or can I do multiple property?
You can do multiple. Section 54, you can have multiple, like I bought one, sold it after 3 years, and again sold that, again bought another one. I can do this multiple amount of time till the time it's a long-term capital gain.
Okay.
So long-term capital gain is when it has passed 24 months.
24 months.
So
okay,
then
for
only the section...
For a physical asset. Yeah,
yes, then only section 54 applies.
There is also a rule, I remember this during a Piyush Goyal budget,
yes,
as rare as that was. In fact, that was only 1 year over the last
yes,
decade or so, where they allowed you to invest on behalf of your child.
Yes.
So you could sell a property and you could invest in your children's name, and
yes,
2 properties were allowed, if
yes,
I'm not mistaken.
So what section 54 primarily checks is that the proceeds of the sale should have been invested back. So like my father sold the property, the proceeds came, he invested into another property and bought it in my name. That is fine.
And how many times can you do that?
You can do that 2 times.
Okay.
Even if you are doing multiple times, the income tax department will what primarily check is whether the proceeds were were reinvested or not. That is the primary thing which they check while doing the reinvestment.
So important to put your money in that capital savings account.
Gain savings account.
Or to utilize it immediately.
Yes.
Okay. And within the time frames that you've talked
yes,
about. The last point is that it's fallen off now. People are not doing this much, and I want to know why you think that is the case. Is that you have these tax saving bonds which you
yes,
can put it in as
yes,
well. There is a tenor that you have to hold for, but the coupon is actually pretty
yes,
low. The interest that you earn is pretty low.
Right.
Is that the primary reason why
yes,
people are not?
So the second section which I said, one is section 54, second section is 54 EC.
Sure.
What happens in EC is maximum up to 50 lakhs of capital gain, you can invest into a bonds, which is NHAI or REC bonds.
Okay.
Now this has to be done within 6 months of selling.
Sure.
Please remember, in section 54, the amount has to be deposited in capital gain savings account before filing of return.
Yeah.
But in this case, section 54 EC, the amount has to be invested within 6 months of selling the property. Sure. Maximum amount you can utilize is about 50 lakhs. The only thing is, caveat is, the interest rate is almost about 5 to 5.25%. That also is taxable.
Oh, it's taxable.
So after tax, you will get a very like 3-4% kind of return, and it's a lock-in for 5 years. So we generally don't suggest it to people, because what you are making 3-4%, you can rather put it in an FD also, or probably in some other bonds which gives you 8-9% and get a better return.
And you can recover the money that you spend upfront.
Yes, yes. So, and as it is, the exemption is maximum to 50 lakhs.
Sure.
So on 50 lakhs, if you see 12.5%, the maximum amount you will save is about 6-7 lakhs,
yeah,
which you can easily generate by putting it into a better avenues.
Yeah, even if it is invested in a mutual fund for the long term.
Yes.
Fantastic. I think we've covered a lot of ground. Thank you so much for joining me today.
Thank you.
All right. So that's everything that you needed to know about selling a property. We've covered a lot of ground, but still, if you've got questions for us, write to us in the comments section and we'll take it up.